Hello and welcome to my latest video. This video is on dividends versus salary. I know in the business community and among accountants and financial planners and all sorts, this topic is debated pretty often. And a lot of people, especially prior to tax changes and things like that with integration, it was very common for business owners, small to medium-sized business owners, to take dividends and just dividends. There was tax advantages to this, and basically it meant that at the end of the day there was more money in your pocket. Since 2018 though, when kind of the tax rules changed a little bit, and it was the whole reason for the rules was to make it not as advantageous to business owners depending on how they took their compensation, where they chose to invest, and a whole slew of other things. And while not perfect, it has definitely shrunk that gap. And it is no longer a very easy one way or the other. But there is a way when it comes to financial planning that I tend to lean for clients. And this video is about looking at that way. So here we have the numbers. I base my decision on numbers. I have no personal care towards one way or the other, so it all comes down to the numbers and what the numbers say. So here we have an individual, a business owner, taking $250,000 in total compensation. So we have one who takes dividends and one takes salary, and the idea here is that this individual takes good care of their finances. They try to optimize their current situation and taking advantage of any benefits that one may have over the other. So first thing that is often talked about is CPP. So if you take dividends, you don't have to pay into CPP. These numbers are based on the 2022. So basically it's asking what would have been most beneficial for the 2022 tax year. So here we have let's start on the dividend side. So dividend, they then get their corporate tax. This person qualifies for the small business tax in Saskatchewan. That means that's probably to go up in the future, but they're currently not paying any real provincial tax. They have the federal tax, and that's paid at the corporate level. Then the individual will get paid what's left, and it's a non-eligible dividend. So they have this $6,000 of tax here taken off. Basically, net to the owner, they get $161,000 net. Cool. Dividend, salary, you have to pay CPP on both ends. So that's $7,000 automatically that you're worse off for. But you pay into CPP. That's a debate for another time whether CPP is worth it or not. And then we have your personal tax. So all in all, net to the owner, you're ahead by $5,500 if you take dividends. And this is where a lot of people will stop the calculations, and it's really important that we don't, because that's not the full story here. So what happens when they start to then save and get onto that side of things? So at the end of the day, dividends paid a little bit more federal tax, but then there's CPP. So it means that's why there's the difference here, and why dividend person has more in their pocket than salary person at the end of the day. So then there's a pretty famous 20-30-50 rule. 50% of your income towards needs, 30% towards wants, 20% should be saved. So keeping that process, because it's simple, in mind, we're gonna say that each one of them saves 20% based on the lower amount. So 20% of this 155 is what's saved. And then we have the dividend person, because they have that added benefit, they're also putting that aside. So they're taking advantage of the fact that they took dividends versus taking salary. So then they have so then going further down, there's an important thing to know about salary versus dividends, is that salary does earn RSP room, while dividends do not earn RSP room. So in this case, there's a $29,210 that can be put into RSPs, and that for the salaried individual means a refund of $13,698 And again, they will invest that because that is an added benefit to taking the salary over dividends. So it means total amount going towards savings is $36,000 on the dividends, but $44,000 on the salary. But remember that a big chunk of this now, tax has to be paid on it in the future, and we'll get to that. So net, what you'll notice is net, they have exactly the same amount. That's the way that this calculation is based, is that there is no difference to each person versus how much that they can spend today. Each of these two individuals can blow $124,788.80 that year and be, so they'll be in exactly the same position financially. The only difference is the decisions that they've made. Okay, so RSP, obviously that's where the salary, the first part goes. TFSAs next, and then everything else gets put into the non-registered accounts. That's taxable as you pay tax on it kind of as you go. One thing to note about the next part of these calculations is that I've kind of trying to be building this so that anybody can kind of play around with it. These next calculations, especially the non-registered stuff, because the tax side of things, I use my own financial planning software, which the general public does not have access to. I could not find a good enough one for me to use free version. So, I've added some other links to ones that will do the job, but it won't be as accurate as well. This isn't, and to be honest, financial planning, a lot of it is educated guessing. Like we don't know what the returns exactly going to be. We don't know how exactly the tax rates are going to change, but whatever in the future. So this is as if everything is equal. So using all the information we have today and making decisions based on that. So anyway, this is what they do every single year. So this part here is what they do for 20 years. So they're saving for 20 years. Their return is 6%. Where do they kind of end up in the future? So we have salary person has an RSP here that dividend person won't have. They both have the same amount in TFSAs. Non-registered account is obviously much bigger for the dividend person and not as big for the salaried person. And there's an important thing to note that CPP, dividend person, does not receive CPP throughout retirement, whereas salary person has been contributing to it. But anyway, where does that end once all said and done? Because it's fine doing the numbers, but as we said, this money, they have to pay tax on this as well. So we've assumed a 5% rate of return throughout a 20-year period. So this is like you're trying to die broke. You're trying to spend every single penny. Probably wouldn't recommend this as a retirement strategy, but just basic looking at numbers. So it means that the first person would be able to withdraw about $91,000 a year for that 20-year period. They would pay tax on that, obviously. So of that $91,000, they'd be able to spend $68,000 of it. They then would be able to spend $17,000 each from TFSAs. And then non-registered person would be able to spend $72,000 from their non-registered account, while salaried individual would only be able to spend $23,000. What does it mean? It means all said and done, there is a $19,000 difference-ish on what they could spend annually, with everything being the same. Living the same life, just making that small change between salary versus dividend. And there is an important thing to note, is that the salaried individual, on top of having $20,000 more to spend a year, they also have CPP to spend on top of that. So that would be taxed at whatever the marginal tax rate is, but they have that in addition to this tax, to this difference, this spending difference. And that is the reason why my recommendation is, especially for the 2022 tax year, is to have taken salary over dividends, at least to get the RSP contribution room. So if you're not, well, then the question has to be, why not? It definitely should be the rule as opposed to the exception. And there's very few people I've met that they would benefit more from at least taking that first little bit in salary. So anyway, if you have any questions, if you have any, if you want to know more or anything like that, or even if you want access to run your own numbers through this, or would like to do that with me, just let me know. And it's important to know that this is something that should be revisited every few years. A lot of the reason why I'm seeing a lot of small business owners not making this change is because prior it used to be the right decision to take dividends, and maybe that formula, that math has never been revisited. So it's something that definitely should be revisited. The whole point in financial planning is purely just to make the best decisions with the information that we have. And the biggest argument against taking the salary is always the CPP. Contributing to the CPP, we don't know whether the CPP is going to be there. We don't blah 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 blah. You're still further off ahead just using the RSP, which we know is going to be there, versus the CPP, which we can get into the argument later, but this isn't even including using that CPP benefit. So anyway, I'll see you guys later. Thank you. Bye.